The world of modern finance is filled with assumptions. We don't question markets are stable, borrowing is safe, and the financial system is far more transparent today than it was during the crisis of 2008. But what if all of those assumptions were wrong? What if the next crisis wasn't forming inside banks, or the stock market, or even the bond market, but inside something far more hidden? Something that has quietly ballooned into a multi-trillion-dollar force with almost no oversight, no transparency, and no public understanding. This is the chilling question raised when BlackRock, the world's largest asset manager, issued a rare emergency warning, stating that the private credit market is overheating, overstretched, and potentially spiraling into a dangerous bubble. A bubble that could, if it burst, trigger a chain reaction across thousands of companies. And the most unsettling part, to understand the danger, we have to begin with a simple truth. The financial system you think we have is not the one we actually live in. For most of modern financial history, corporate borrowing was a predictable two-lane highway. Companies either went to banks for loans or they issued bonds and stocks in public markets. Banks had regulators, disclosure rules, and capital requirements. Public markets had reporting standards and investor protections. All of it created a structure that, despite flaws, was visible, trackable, and somewhat controllable. But then came 2008, and the financial system experienced a collapse so violent that it didn't just take down banks, it took down trust. Lending froze, credit evaporated, and thousands of companies suddenly found themselves cut off from financing. They needed capital, but the institutions that used to lend were wounded, timid, or shutting down entirely. And into this chaos stepped a new class of financial actors, hedge funds, private equity giants, institutional investors, and massive asset managers like BlackRock, Apollo, Ares, KKR, Blackstone, Carlyle, and others. They became lenders. This new system was called private credit, and it grew inside the shadows. Private credit was the perfect loophole. It allowed lenders and borrowers to structure deals in private, hidden from markets, analysts, journalists, even government regulators. And because banks were wounded after 2008, companies turned to private credit because it was fast, flexible, and secret. Lenders loved it because they could charge high interest rates, gaining leverage, control, and huge returns. Borrowers loved it because they could avoid showing their financial weaknesses to the public. The result was a quiet, explosive boom. In 2010, private credit was a $300 billion niche, and by 2024, it crossed $2.1 trillion, with projections that it could reach $4 to $5 trillion by 2030. Private credit became the fastest growing part of global finance, bigger than high-yield bonds, bigger than leveraged loans, and big enough to reshape corporate borrowing forever. But size wasn't the only danger. The real danger was that this market grew with almost no safeguards, new visibility, and no historical stress events to test whether it could survive high interest rates, rising defaults, or economic slowdown. And that's where BlackRock's warning becomes terrifying. For years, BlackRock was enthusiastic about private credit. They built teams, funds, strategies, and entire business units around it. They supported the growth. They helped push the narrative. But recently, BlackRock broke its silence and publicly stated that the private credit market is facing serious systemic risks, including overvaluation, weak loan protections, excessive leverage, opaque pricing, and an alarming rise in stressed companies. When a $10 trillion asset manager issues a warning, the financial world listens. Because BlackRock does not exaggerate, they do not panic, and they certainly do not call attention to problems unless the problems are big. But before we get to the breaking point, we need to understand the rise to cause and effect chain that led private credit from a clever workaround after 2008 into a global shadow banking system that may now be too large and too fragile to unwind. Banks were scared. Regulations tightened, and companies needed money quickly. Private lenders stepped in and filled the gap. At first, the terms were conservative good interest rates, solid collateral, and stable borrowers. But as returns attracted more investors, competition intensified. Funds began lending to weaker companies to win deals. Lenders began stretching, a term used to describe giving large loans to companies that would never qualify under traditional banking standards. As zero interest rate policies kicked in, private credit hit turbo, companies refinanced debt at cheap rates, Investors poured billions into private credit funds seeking higher returns than public markets could offer. Every year, the industry pushed boundaries to keep money flowing. And every year, the risks quietly grew larger. When COVID hit, private credit became the backstop, again rescuing retailers, manufacturers, airlines, hotels, and companies on the brink of collapse. But instead of allowing bad companies to fail, private lenders extended credit and refinanced again and again and again. Zombie companies' businesses that cannot survive without constant borrowing exploded across the economy. But everything changed when global interest rates surged at the fastest pace in modern history. Suddenly, borrowing costs jumped from near zero to over 5%. Companies that had taken private loans at 7% were now refinancing at 12%, 14%, even 18%. Cash flow evaporated. And because private credit deals are hidden from the public, these failures started happening quietly out of sight. When interest rates rise, bad loans surface, weak borrowers collapse, overstretched lenders face losses, and private credit built on high-risk loans, low transparency, and aggressive financial engineering starts showing its cracks. BlackRock warned that many private credit loans are overvalued by fund managers who daren't want to report losses to their investors. They warned that protections in loan agreements are historically weak. They warned that investors in private credit funds may soon be trapped, unable to withdraw their money. And they warned that companies relying on these loans could face a wave of defaults that cascades through the economy. Corporate bankruptcies have accelerated to multi-year highs, and private credit lenders are being forced to take over struggling companies, renegotiate loans, or extend maturities to avoid reporting losses. These extend and pretend strategies only delay the inevitable. At Chisami point, the math stops working. This leads us into the fallout phase of the part. Few people understand because it happens behind private walls. Anel has warned hundreds of private companies can collapse without public awareness. One major player falls so loudly that the market can no longer ignore the cracks. Private equity-owned companies, which are heavily dependent on private credit, are showing signs of stress across retail, real estate, healthcare, manufacturing, and services. Many of these companies already operate with thin margins. Those investors' pension funds, sovereign wealth funds, insurance companies, endowments have their own liabilities to meet. And because private credit is illiquid, investors cannot exit quickly. A liquidity mismatch occurs more investors want out than the fund can cash out. This is how fund freezes begin. The same pattern happened in 2007 with structured credit products. Now imagine this happening across a $2.1 trillion system with almost no transparency. This brings us to the failed fixes: extending maturities instead of accepting defaults, inflating valuations to hide losses, negotiating payments in kind loans where borrowers pay interest using more debt, restructuring loans to avoid triggering defaults, transferring debt to new funds to disguise failures, and using complex refinancing structures to shift risks out of sight. These fixes do not repair the damage, they bury it. In 1998, with long-term capital management, leverage and opacity created systemic risk. In 2000, tech valuations grew disconnected from reality. In 2008, structured credit products were mispriced by models that discounted risk. Private credit mirrors all those patterns. Rapid growth during easy money, aggressive lending during booms, opaque pricing, overconfident modeling, illiquid structures, delayed recognition of losses, and interconnected players who rely on each other not to fail. Even worse, the companies relying on private credit today operate in the real economy. If private credit shrinks, those companies lose access to funding. BlackRock's warning is not about one fund or one lender or one company. It's about a system reaching its stress limit. Every bubble has three signs: unsustainable growth, dependence on cheap money, and denial of risk. Private credit checks all three boxes. So what can we learn from this? Private credit grew outside the public eye without the guardrails that keep traditional finance stable. For over a decade, companies borrowed freely under the assumption that money would always be cheap. Borrowing solves problems in the short term, but magnifies them in the long term. Without visibility, regulators cannot intervene, investors cannot prepare, and markets cannot price risk accurately. BlackRock's warning is not a prediction, it is a signal that the system is under strain, that cracks are forming, and that the era of easy credit has ended, leaving behind a fragile architecture built on leverage, confidence, and silence. The question now is simple. Does the bubble burst loudly or quietly? Does it unwind gradually or suddenly? Does it take down a few borrowers? We don't know yet. But we do know this. The more people understand private credit, the safer the system becomes. Real-world economics and the shocking stories behind global markets.